A former Bank of England official said Bank of England policymakers had a responsibility to push Britain into recession to limit rising inflation when they meet this week. Adam Posen, director of the Peterson Institute think tank in Washington, said that while the Bank of England did not want workers to lose their jobs, it was time to raise interest rates to offset rising inflationary pressures from Brexit trade and immigration restrictions. The Bank of England's Monetary Policy Committee meets on Thursday and is expected to raise interest rates by 0.25%, bringing the central bank rate to 1%, the highest level since early 2009. Inflation peaked at 7% in March, the highest level in 30 years. Posen, who was a member of the MPC from 2009 to 2012, said the central bank needed to take tougher action after Brexit reduced Britain's labour supply and limited workforce flexibility. If the government does not turn around on trade restrictions and immigration policies, the Bank of England will have to shrink the economy. When prices of all kinds rise sharply, central banks have no choice but to create a recession, he said. It is committed to lowering inflation more than a year later if inflation is more than 2 percentage points above its 2% target at full employment. Wages will rise due to labour shortages, which could add to inflationary pressures for years to come, barring further rate hikes, he said. He added that if wages fail to keep pace with inflation later in the year, it would show workers weak bargaining power and more reason to curb price increases. Compared to other major economies, the UK faces a greater risk that inflation will persist without further action. The US is going through a period of high inflation that will hamper monetary policy. In addition to energy and food prices due to the war in Ukraine beyond the surge, there is no real inflation in Eurozone countries. Brexit, on the other hand, will limit labour supply in the long term, and trade restrictions will keep prices higher than they would otherwise be, he said. Academics and city analysts are divided over the central bank's next move, with some, including Danny Blanchflower, a former Labour economist at MPC in Posen, arguing that a rate adjustment is needed.